just in case you want to watch the session afterwards or share it with anyone who might benefit from it as well. Now, today's session is focused on SAFEs, which is a simple agreement to future equity, as well as convertible notes. And these are two of the most popular early stage funding options. So if you are considering raising capital or even considering the SheBoot program, this will be a great session for you to learn more about these two different funding sources. We're going to cover a bit about SheBoot in the program since we do have our applications open right now. We're going to cover what SAFEs and convertible notes are, the benefits and drawbacks of each, and the key differences and maybe when each of them should be used in your fundraising strategy. So with that, I will go ahead and share screen and we can get started with today's session. I will pass it over to Jane, who will share a little bit more about SheBoot and the program.
Thanks, Nadia. Hi, everyone. I'm Jane Baird. I'm the Executive Director of SheBoot. And as Nadia said, we're going to start with a bit about the SheBoot organization and the program before we dive into the safes and convertible notes. So just to let you know, at an overall view, we have a dual mandate at SheBoot, and one is to address the systemic challenges that women and non-binary founders face when getting funding. As you are all, I'm sure, painfully aware that the majority of angel and VC funding goes to male founders. And so our aim is to really address that and try to increase the access to capital for women-owned and led scalable tech and tech-enabled businesses. A second part of our mandate is to get more women investing. And so we have a cohort of 30 women angels who participate in the SheBoot program by putting in $10,000 each in angel investment. And that gives us a prize package for our founders at the end of our program, which I'll get to in a moment. So as Nadia mentioned, our applications are open now. They're open until May 2nd. To be eligible for the SheBoot program, you must be a woman or non-binary individual leading a tech or tech-enabled business, as I talked about, and having a minimum of 33% ownership in that business. You also must have a decision-making title of COO, CEO, or CTO. Your business must be incorporated and headquartered in Canada. And we're looking for innovative, scalable tech companies that are showing some signs of traction, whether that's in early revenue. And that would depend on the industry, because obviously things like med tech and health tech, it takes a longer time to get to revenue, but you may have a product in beta testing, getting some customer feedback. So it's more than an idea on a napkin. You've actually got a business started. Next slide. And do you qualify as tech? Jennifer is the expert explaining this, so I'm going to turn it over to her to do that.
Yeah, so what we're looking for is a tech or a tech-enabled company. So obviously a tech company would be a software company, a health tech company, life sciences, med tech, digital health, deep tech, some level of IP aspects with that technology. Tech-enabled, we're looking for a business that has a tech aspect to it, but may not be a core tech business. So you might have a consumer product, but there's some tech in it, like Nadia, who is hosting our call with Marlo. They're tampons, consumer good, but there is a secret sauce tech enablement around the lubrication and the way that works from an IP perspective. Or Alt Advantage Pro, which used to be Hope Pet Foods, a winner from a previous year. It's a pet food business, but it is pet food from a proprietary insect formula that they are using for the food. So it's got that tech enablement that provides unique differentiation and also enables the company to continue to scale with that differentiation.
So just an overview of the SheBoot Bootcamp, which begins in September. We have a 6-week program. There are 2 workshops per week, 2.5 hours each, Tuesdays and Thursdays, on all the kinds of topics that you're going to need to get ramped up on in order to pitch to angels and VCs. So things like due diligence, preparing your data room, legal, financial, accounting, sales, the whole gamut. So those workshops run for 6 weeks, every Tuesday and Thursday. And on Fridays, we have a pitch practice where the founders pitch in front of investors, community champions, people who have volunteered to provide frank and friendly feedback on their pitches. And it's every Friday, as I mentioned. So it's great to get that feedback week after week and to see that from our perspective, to see the improvement week after week on the founders' pitches. Each successful founder is paired one-on-one with a coach who kind of walks alongside with them through the whole program from the beginning to the end, helping them internalize some of the workshops that they're taking, that they're part of, the feedback that they get on the Fridays, and the pitch practices, how to incorporate that into their presentations, and really just kind of keep them well informed of the program and there to ask questions and provide counseling throughout the whole thing. It's a whole community of supportive and like-minded women who kind of surround this group. And actually, if you go to the next slide, oh, actually, in the next slide, we talk about a circle of support in the following one. But just some sample of the workshops here are some of the titles. You know, how to pitch. We have a who to pitch to, how to manage difficult questions, legal discussions and deal docs, trademarks, trade secrets, how to explain your product market fit, how to demonstrate customer validation to investments. And every workshop has an expert workshop lead paired with an investor, so that there's always an investor in the workshops to bring that investor perspective, kind of underscoring why this is important and why it's what the investor perspective is, in terms they look for from a founder. Then that circle support I mentioned, you've got your one-on-one coach. We set up a ghost board for each of the companies, which is 2 or 3 women of, from different sectors, different expertise, to kind of help you as you are kind of coming out of the program, graduating from the actual program, and kind of mapping out your investment journey. Throughout the program, we also have hours contracted with marketing, legal, and sales advisors and finance advisors who we pair with you as well through that program to kind of help make sure that you've got all of the T's crossed and the I's dotted when you're about to pitch your for investment. The 6-week program culminates in an investor pitch day, which is a full day where each of the founders, we select 15 founders into the program. I don't think I said that. Each of the founders has 12 to 15 minutes to pitch their investment and have questions and answers from the investors. From those pitches, we select a first and second and third prize winner. You can see the amounts there that are won from that $300,000 prize package that I mentioned from the 30 women angel investors. That happens at the end of October. We make a kind of public announcement about it early in November in a kind of a broader community event where we bring all kinds of investors, VCs, other founders, SheBoot alumni together at a celebratory event to celebrate the winners, to celebrate all of the graduates from the program. And that we kind of pair that with the SAS North conference, which happens here in Ottawa. Bring all this is the one in-person part of our program. All the founders come to Ottawa, go to this our grand finale event, and then SAS North, and with the intention of exposing the founders to as many investors and VCs as possible. So over the course of the SheBoot, we just completed our 5th cohort. So we've had a total of 65 program graduates. 52 women angel investors have been involved in the program, which we're extremely proud of because, as I mentioned, part of our mandate is to get more women involved in angel investing. So from those women angel investors, 1.3 million has been invested in SheBoot companies. And then even more impressive is the 40+ million that SheBoot alumni have gone on to raise in follow-on raises. So that's the program in a nutshell, and I'm going to turn it over to Jennifer to walk through the safes and convert. Actually, before we do that, are there any questions on the program itself? Can my partner apply with me? If you mean partner like a co-founder, that would be one application. We've had founders get selected where there's 2 co-founders and they both attend all the sessions throughout. That's up to you. Sometimes you can tag team if that works better. Great. We can come back to some of those other questions. I don't see if there's anything specific to the program right now. Jennifer, do you want to take it away with the safes and convertible notes?
Great. And if there is background noise, I apologize. I am at the Discovery X conference and I am in the speaker room with the door closed, but there are noises around. So what I wanted to do was talk to you about different types of offerings and securities for when you're raising. And some of you might already have used them because we do frequently seek companies that have already done a friends and family round and have used an investment vehicle for that. So typically at the very early stage, so friends and family and angel investors, there's 3 different mechanisms that people use. There's common shares, which is where you are bringing on your investors or your friends and family on the same share terms that you've got. There's convertible note or debenture, which is a debt style vehicle, but with an opportunity to convert into equity, and the SAFE, which is a simple agreement to future equity. So we'll talk more about each of those, but those are the 3 mechanisms that you'll likely use for your early rounds. And for any raise that you do, it needs to be in compliance with securities laws. So every issuance of security must fall within a prospectus exemption. There are rules around who's allowed to sell shares in their company and who they're allowed to sell them to. For instance, at the very early stages, founders, employees, families, and close friends. Those are the friends and family rules, and there will be a form. So whoever is investing under that exemption would be signing a form to say, yes, they really are a friend or a family. And otherwise, if they're not a friend or family, then they have to be an accredited investor. A accredited investor is someone who has sufficient wealth, which is in Canada, $1 million or income of 200,000. There's a few other categories, but those are the basics to be an accredited investor, and then you can raise money from them as well. To start the common share offering, so a common share offering, you're saying for $100, you can get 0.1% of my company or whatever it is. You see these on TV. I'll give you 100,000 for 10%. That would be a common share offering. You're setting a value for the company, and you're buying a piece of the company for that money. You do have to create that valuation. So there's 2 stages where common shares are typically used. One is near the beginning, where your value is quite low because you haven't done a lot. And so, you're saying to friends and family, I'm just going to do common shares. It's simple. It's easy. I don't know how long you're going to be invested in my company. So I'll give you a portion of it off the bat. And, typically you would see in the early stage evaluation between 1 or 3 million when you're using a common share for friends and family. When you're doing the founder shares right at the very beginning, you might have a $0 value. And then when you start bringing in friends and family, you're in that somewhere in that 1 to 3, and it's low enough that you can agree on what a number is. Once you start getting a little bit bigger, or you've built up more IP, it can be more complex to decide the valuation. And so typically, if you're raising that little bit later, you're going to punt the problem to somebody else to decide how much the company is worth, and you will raise on a vehicle that has a delayed valuation, which is a convertible note or a SAFE. They bridge the gap before you get to the priced round, which is typically an institutional investor who's got staff that will be working on figuring out what the valuation is with you. So when you do a convertible vehicle, a convertible note or a SAFE, you will typically have a valuation cap in that vehicle, as opposed to an uncapped vehicle. So the valuation cap is saying, I'm going to give you the money now. We don't agree on what the valuation is, so we're going to use a note or a SAFE. But I am going to put a cap on how much, so that if I give you my money today, and so let's say I negotiated just a 20% discount, right? So when you raise a price round, I'm going to get a 20% discount on that raise. And your company was probably in the $3, $4, $5 million range when we did that, but we went with the convertible vehicle. And you work on your stuff, you build all sorts of value into your company, and by the time you do the priced round, your company is worth 20 million. So the return on I get on my investment over that period is 20%. Right? You get, that full growth from that 0 to that 20 million. So I want a better return on my early equity into your, my early capital into your company. So I'm going to put a cap on that to say, that when you raise, my money is either going to go in at a 20% discount or it's going to go in at the cap value. So I'm loosely thinking, okay, I think you're probably in that 3 to 5 now. I'm going to put the cap at 7. And then if you get to 20, I convert in at 7 and I get a lot of that upside with you because I put the capital in to allow you to do that growth. Right. So those are the sorts of things that are going on with that cap. And then the discount is the discount. So if the cap is above the valuation that the price round came in at, I would get the discount instead of the cap, as that would be better for me. Okay. So you've got the SAFE agreement to go through. So SAFEs and convertible notes are quite different, and you're going to get opinions if you're choosing between a SAFE and a convertible note as to which one's different. So it's important to understand the differences of the two vehicles. So a SAFE is an agreement for future equity, and the convertible note is debt that converts to equity, but the debt is not repayable if it converts to equity. So the debt accrues, and then the debt plus the interest all convert into equity at the time of the priced round. In a SAFE, there is no debt vehicle, so there's no accrual of interest, there's no repayment. It just sits there until it converts in. Typically, SAFEs have no maturity date on them. So if you download a SAFE from Y Combinator, there will be no maturity date, there will be no interest rate. It will typically have a valuation cap. It will typically have a discount, and it may have something called a most favored nation clause. You will sometimes see that in both vehicles. So why do investors not love SAFEs? Or when do investors feel comfortable with SAFEs? So the issue with the SAFE is that the SAFE doesn't accrue any interest, doesn't have a maturity date, and nothing happens with it if you don't do a priced round or if you don't exit. So I give you my money. It's a very simple agreement, especially if you just use the Y Combinator one. Many times those are done without any outside legal counsel because it's a really simple agreement. You can read it. It's pretty plain English. So it's very simple from a legal perspective. But what happens with the SAFE is, so I put in my 25,000, I do it as a SAFE. And
Thank you.
so option one,
Thank you.
It takes you 10 years before you get to the price round. So my 25,000 didn't gain any interest. It was put in at $2025. It converts in $2035. So it's actually worth substantially less than it was. So I lose money on that deal as it converts over because it didn't stay up with inflation. But it did eventually convert. So I still have a mechanism to get my money back. If you don't go for a priced round, if you get to profitability and you continue operating, that SAFE just sits there. So you have my cash, but I have no way to get it back and you're still successful. That's good for you as a founder. It's not great for me as an investor. So when I look at a company and I think, they might not need venture capital, they might be able to get to profitability without it, a SAFE is not a good vehicle. When is a SAFE a good vehicle? A SAFE is a good vehicle when I know you need venture capital. I know that that's your plan to scale, and I think you're going to be able to get there in the next 12 to 24 months. So the lack of interest isn't critical to me. I think there's a lot of upside. I think it's going to convert fairly quickly. And a SAFE is a great vehicle because it's simple, it's easy. I don't need legal review. It's cheaper to do it. And it's going to work because you are going to go for a priced round. If I'm not sure when you're going to go to a priced round, so it could be years from now, or it might be never, then I'm going to look at a convertible note. Because that convertible note, if you do a priced round, it converts to equity. I get the interest on it. So my money stays up with inflation and I earn a little bit for you having the use of my money over that period. And if it does, if we decide after the 24 months to convert it into equity and you decide to go profitably without an exit, you can do things like I have a company I've invested in that's doing dividends as a shareholder to the shareholders because they've gone for the profitability route. So there's other ways to repay the investor when they've gone with a convertible note, but a SAFE would just be sitting there. So, if you want minimal negotiations, simple terms, very little legal, and you're going to be going the venture capital route, a SAFE is a great vehicle. If you're not sure whether you're going venture capital or not, then it's better to go with the convertible note. So just to reiterate some of that, so this is the simple agreement for future equity. It is a simple way to raise capital without putting a clear valuation on the company. It leaves a lot of flexibility to the future. They're not debt. They don't have maturity dates. They don't have interest rates. So with that, it's typically a one-page agreement. I would provide you the cash today. You would have the use of it to grow and scale your company. And it would then, convert over when you raise. So I put in this example, the 100,000 with a 5 million cap. You later raise it at 10 million. My money converts at the 5 million cap, and I get the upside of the difference between the 5 and the 10 for the investment in the time that you had my capital in order to grow your company. So they are quite founder friendly, and you will definitely get people telling you always do safes, everything should be a safe. And they will tell you in the US, they always do safes, just do safes. And there's a reason for that. It's because it is very founder friendly. In Canada, you will find a lot more convertible notes, and that's because we tend to have more bootstrap companies, more companies that don't go the venture path, or sometimes takes longer to go the venture path. And so if you've got the attitude of go big or go bust, I'm going to invest, and you are either going to fail or you will raise venture capital, and then SAFE is a great vehicle, but in many cases we have successful companies that don't do either. So makes a note the better vehicle. One thing to consider when you're doing safes, and the same with notes actually, I have certainly run into founders that have lost track of how diluted they are. So you do your friends and family round on a safe, you do an angel round on a safe, you do a bridge round on a safe, and you've now got 3 safe vehicles that all have maybe different caps on them, where you've just lost track of how much you actually sold. And so what you should be doing is you're looking at a new investment round is trial conversions like on a spreadsheet, but on a spreadsheet running through different priced round values, and look at how diluted you are if you've got multiple safes. It's much easier if you've got one safe to track, because everyone's converting based on the same cap. But frequently there's multiple safes out there with different caps, different discounts. So doing that practice conversion to see where you land before you do another safe, to make sure that you're retaining equity to be able to go through the venture rounds later is really important. So I think I've kind of spoken to some of this, but so the convertible notes are a little bit different. So they are a debt vehicle. So I am lending you the money, but I'm not taking any interest. So the interest is all deferred. So the interest is deferred until either the conversion event or the maturity date. So so let's say we set the maturity date for 3 years. So for 3 years, you have access to that capital without having any repayment obligation. At the 3-year point, if you haven't converted, you've got a couple of choices typically with your investors. One choice would be to convert it to debt and start a repayment on that debt. And then it becomes a straight, simple debt. Another choice, sometimes, there will be a discussion, can we convert the debt into equity at the cap? And just do that, even if you haven't got a price round, you just convert it into equity at the cap. I have a deal that did that last year on the maturity date as opposed to repaying it. Or it converts because there has been a price round. So again, so just going through, so one thing to keep track with the interest rate is, again, looking at how diluted you are. So if you've got a convertible note, so 5 to 8% is relatively friendly. You will sometimes see convertible notes that are much higher, that are in the 10, 12, 15%. And when that's the case, you need to be tracking over time how much that's worth, so that when it does convert, you know how much you've given up. Right. So if you do a convertible note at 12% and it takes you 5 years, you know, you've got a lot of accrued interest sitting there that you need to calculate in terms of how much equity you're giving away at the conversion event. So it's really important to think about that interest rate and how long until the maturity date or until the conversion event you think it's going to be, so that you know what you've really given up. Whereas say, 5, 6%, even 8% is much closer to, standard interest rates. And it's really more about the investor keeping their position based on inflation and interest. Whereas if you're getting more 10 to 12, they're making money off of the interest, and you need to be thinking about how does that impact you if it takes you 5 years before you convert. And so notes are a little more investor friendly because it protects the investor against more scenarios in terms of how you decide to grow and scale your company. It's a structured agreement. It's got more formal terms. It's got different ways that the investor can be repaid. It gives you more flexibility. And many investors will, at the early stage, will only do notes because they don't know what path you're really going to wind up on. And many investors are familiar and comfortable and have, many samples of notes they've worked with, which can reduce the legal cost quite considerably if there's already notes or convertible notes that they're willing to use that have already had legal review. The drawbacks, as I said, is, you do have that debt obligation on the maturity date. But you did take the money, so there can be maturity date pressure, so you should have a good sense on whether you've got the right maturity date. If you're not really expecting anything to happen in 12 months, don't do a maturity date of 12 months. It just means you're into a discussion with your investors and a legal discussion way too soon. Right? You should be looking at 24 to 36 month maturity dates so that you're not, running into negotiating with your investors on the maturity date before you've even really gotten anywhere. So thinking about that maturity date, because when you do hit that maturity date, and I've had a lot of notes that hit the maturity date before a conversion event, that is a discussion. It can involve lawyers, it can be expensive, and it can be fraught. So making sure you've got that maturity date right, so you're not under high pressure on it. And it does have more legal complexity because you are dealing with that combination of the agreement for future equity and the debt provisions. From a, as you're working through with investors, you will typically, not always, and especially if you're not just discussing a safe, you might have a document that sketches out, we've agreed on, we're going to use a convertible note, we're going to use this as a cap, we're going to use a 20% discount, and it's going to have 8% interest. And so you've got the basic structure of what the deal will look like, but you don't have it legally papered. And that can be a much easier document to go back and forth, make sure you've got an agreement on the business terms before you get the lawyers involved. Because if you get the lawyers involved before you've got agreement on the business terms, your legal costs will be substantially higher because you're going to do multiple rounds with them. So to bring your legal costs down, you use a term sheet, get agreement on all the business terms, and then paper it. There was a question of how is the interest rate determined? It is agreed upon between the investor and the founder. Some investors are just, I just want to keep it at interest rate. So yeah, so it would be prime or prime plus a percentage. If you are getting a convertible note through more of a bank structure or, some of the pre-seed funds, you might find that you're getting, maybe double or triple prime. So I think, I've seen 12% on convertible notes from some of the institutionals or banks. So, but it's a negotiation and you can decide not to take that. You might decide it's too expensive money. depending on the interest rate.
Awesome. I'm going to just quickly stop sharing so I can see if there's other questions in the chat, but that concludes the formal portion around the lesson of safes and convertible notes. So if you do have any questions, you can come off mute, or I'll look through the chat and see what's coming in here as well. But feel free to come off mute and ask any questions if you have as well.
Okay, I'm going to answer a question that none of you are asking. Just to just put it on there. So we do get asked, how does SheBoot invest? You know, as you're thinking about applying to SheBoot, we have a default convertible note. We will negotiate with each founder on that note in terms of, you know, we don't have a fixed cap. You know, we take in companies that are in different sectors, different industries, different stages. The commonality that all of the founders will have is that they have not raised a significant round from strangers. But other than that, your businesses might be very different. You might have different levels of IP. So we do negotiate the core business terms with the founder before the investment cycle. So before you do the pitch to everybody, we do that. But our default is a convertible note because we also know that some of the businesses will be able to get to profitability without venture fund. We have done safes. So if you have already got a safe that you've used, we will use that. If you've already got a convertible note that you've used, you know, we can use that as well. So we are flexible in the vehicle, but our default vehicle is a convertible note.
And Kathy, you have a question?
Hi, my question is around pre-revenue valuation. I'm really struggling because it's a question I get asked all the time. And you know, some people say you kind of have to make it up, and other people say you have to make a best case guess. What is your sort of, how do you answer that question, and how do I come up with an answer?
So I'm going to just say there's a certain amount of making it up all the way through.
Okay.
You know, you
This
could
is
argue,
excellent, by the way. Thank you.
I mean, you could argue that the valuation of OpenAI for their $40 billion round, which was 75 times revenue, was made up. Right?
Right.
You know, that there are some metrics that public companies generally fall in. You know, so if you look at the public markets, there's PE ratios and things that generally, but don't always. You know, you've got, you know, outliers, meme stocks, things like that, which are just kind of made up valuations. But having given you that unhelpful answer, I will kind of be a bit more helpful. So
Should I tell you kind of a little bit more about my business, or no?
No,
I'll
just
okay.
Yeah, I'll just be more general. So at the very beginning, you're worth nothing. So when you incorporate your company and you set your founder shares, you know, your initial founder shares are at $0 because you don't have anything.
Right.
So typically your founder, and if your co-founder comes in at exactly the same time as you, you all agree that you're worth nothing, and you issue the shares to you and your co-founders at $0 value, and you get 100% of the upside. Then it starts becoming a little tricky because, you know, within a month you no longer have nothing. Right? Now you've got something. Generally, when you have something but not very much, you know, you'll see in the friends and family or the very, very early angels, of which there are not a ton of them, but they do exist. You'll typically see valuations between 1 and 3.5, and a lot of times those are common equity deals because you really don't know yet how long things are going to take. And the convertible vehicles, you really want conversions within a time frame. So in the very early days, when you don't know how many years it's going to be, you might do everybody on equity. And you'll set a valuation that's fairly low because everyone's dream is you're going to be worth hundreds of millions. And so whether we value you right now at 1.5 million or 2 million, it doesn't really matter. It's not material in the long term. So at those lower numbers, you don't get a lot of pushback when you're kind of making up how much you've put into the company at the time that you're doing that very early round. it gets more awkward when you're further along, but you don't have revenue. Right. So when you have revenue, depending on your sector, there's different metrics for different sectors, different types of businesses as to what your revenue multiple is going to be. And then there's hot sectors like AI, where those rules all get thrown out the window and they're just valued for lots of money. But generally, once you have revenue, people are going to use revenue and growth metrics to figure out your valuation. But when you're pre-revenue, you don't have those. So what you're looking at is trying to assess the value of the IP and the product and the progress. And so there are ways to do that. But this is why you wind up with convertible vehicles, because most people will punt that problem down the road rather than trying to assess the value of your IP portfolio or assess the value of your assets, assess the value of your technology or your product. When you haven't yet got sales. So that's why convertibles are so popular in that phase, when you have more than nothing, but you're not in revenue. You will find, like if you're in life sciences, there are comps from the market, because companies get acquired at the end of animal trials. Companies get acquired at the end of human trials. So you can usually find comps in the market to say, this company got bought for this amount, and so I'm at this stage, I'm worth this. And then depending on your sector, you might also be able to find that, where pre-revenue companies have been acquired and you've got evidence from the M&A market as to what your valuation is. You can also look at PitchBook. And look to see, have companies at your stage managed to do a seed or a Series A from an institutional that was tracked by PitchBook, and what was that value? And that can help you with setting it. If you really need a valuation and you've got IP, there are lawyers and accountants that will look at how to assess the value of IP. That's typically not done at this round because no one wants to pay for that. And again, you would go back to a convertible vehicle. Is that helpful?
Thank you. Yes, thank you.
Any other questions from the group as well?
The question was grants. So grants are fine with SheBoot. Angel investors love grants because it helps you fund your company without dilution. And it means that you're not diluted and your investors aren't diluted. So grants can be really good. There are grant programs that are matching programs where you have to find investment in order to get the grant. In which case, the SheBoot, if you win the SheBoot investment, that would count towards that investment that you need to be able to trigger the grant. And yeah, so we're really focused not on how much you've raised from grants in terms of, who we accept into the program. It's, we are looking for companies that are getting ready to raise from angels and pre-seed. And generally, if you have lots of grants, that's good. I mean, depending on your sector. If you're loaded down with debt, it may not be as good, depending on what you've got to offset that debt.
If there's no other questions, you can still feel free to reach out to us at info@sheboot.ca. We're happy to answer any questions that are coming in if you're hesitant on whether to apply or any questions you have about the program or the application. We also do have an FAQ on our website. If maybe something we didn't answer might be available there as well. And as we mentioned, the applications are due on May 2nd, so please do try and get those in the next couple of weeks. And then we'll be sending out interviews to the successful candidates before we pick our cohort. Any other final thoughts or questions that anyone has?
I see one question there, Nadia, from Sally. When does the program start? So the program starts in September. We have our kickoff kind of launch the week after Labor Day, the Monday after Labor Day, and the workshops start that Tuesday. So they run through whatever that date is. I'll say September 10th off the top of my head, but through till the middle of October, and pitch day is at the end of October. So consider September, October, when are you accepted? We, as I mentioned, the applications are due May 2nd. We take about a month to review them all and then do interviews with a short list and select our 15, ideally by mid-June. And you would be informed mid to third week of June.
And full disclosure, while the boot camp starts in September, we do give them summer homework.
Summer homework, yes. There will be at least one session in the summer. You get matched with your coach in the summer as well. And we hope that you have at least a meet and greet before the workshops start in September. You're welcome.
Amazing. Well, thank you so much, everyone, for joining. It was a pleasure to see everyone here. Thank you for your engagement and your questions. And again, if you have any other questions that come up as you're thinking about the application, feel free to reach out as well.
Thanks, everyone.